Good morning, all. I hope you are well. So, I have four pairs on watch this morning. Those are dollar yen, CAD yen, Aussie Swiss, and Euro Kiwi. This may have to be a slightly shorter video than normal because I have a trading webinar to attend at 7 a.m. and it is currently 6:31 a.m. as I speak. So, I may have to go through these a little bit more quickly. But my favorite of the bunch today is dollar yen. Now, what was I saying yesterday on the higher time frames? I was saying that we usually, if we're going to move to the downside, we usually break above and catch people the wrong side of the market if we're going to move to the downside. And what do you know? For the moment, at least, that does look like what's happening. Okay, we've broken above, and you can see prices starting to come back down. Whether it comes back down below this area of value by the end of the day is another matter. But you can see we've had the break above. Okay, many people that were holding this think to themselves, okay, I'm going to get out here, and then it gets there and they think, what if it keeps going? Maybe I'll just hold it a bit longer. That's greed. Okay, the logical business-like decision would be to get out here, but people hold it. It breaks above, the ticker feeds get hold of it and say dollar yen at all-time high or whatever high this is. So that encourages FOMO. People start buying. And I said to you in yesterday's video, I was actually just thinking about this. I said to you in yesterday's video, feel free to go and watch it. I said that when we break above these areas of value and catch people the wrong side of the market, the clue, I said, is that we often get these low momentum candles. So look at these low on the lower time frames. Okay, I initially said the higher time frames and then I corrected myself and said the lower time frames. There we go. Low momentum candles. Okay, that when we break above a high and we get low momentum candles, in my experience, if we just analyze that, that is a good clue that that's not the bigger players. Okay, and it's just people being caught the wrong side of the market before the push down. So with all of that in mind, what I'm going to be looking for very, very simply on this pair today is I'm going to be looking for, and this is a prime example, just to touch on it, why we wait for the push down and the flag. Look what happened here. We got the push down. Where was the flag? Okay, there was no flag, just a wick. So if people had been watching my videos and thought, I'm going to use this guy as a signal service, if they were watching on YouTube and they saw it come down and they just thought, I'm just going to set an order there. I'm not going to wait for the flag. So we got a wick down. You would have been wicked in and wicked out. So that is precisely why we wait for, let's try that again. That's precisely why we wait for the push down and the flag. The flag is the confirmation that price isn't going to do this. Okay. So with all of that in mind, what I'm going to be looking for is the following. I'm going to be looking for a break back down below. So previously I was looking for a break above the area of value. We've got that now. And now I'm looking for a break back below, followed by a 3-touch 5-minute continuation or a 2-touch continuation, a 2-touch 5-minute continuation with a 3-touch structural approach, or the same thing but on the 15-minute chart. Okay, and then I would look to get short on the break or within the structure, depending on whether it was a 5-minute correction or a 15-minute one. Am I bothered about this wick? Not now, because if we normally these wicks hold some weight, but if we zoom out, okay, if we push back down and we correct, okay, that wick doesn't hold, in my experience, wouldn't hold much weight at all. So not bothered about that wick. If we get a push down below here and we correct this, you better believe that this is very, very likely to be coming to the downside. Okay, so because that's very, very deliberate price action. And then what I would do is I'd measure the range and I would target the 90% area where price often pulls back deeply, even if it's going to continue in the forecasted direction. Okay, and then I would trail my stop loss accordingly for something in the region of about 9%, depending on obviously the size of the flag and the stop loss, etc. We had to have. So I've got an alert set just above the area of, or just below the area of value to see if we push below it. If it doesn't trigger, then I won't be looking to place a trade on this pair. Okay, CAD Yen, similar story. Okay, but the reason this is partly lower down on the list is because you can see if we zoom left, we are at what according to my data is an all-time high, whereas CAD Yen, if we just zoom out, there is a high sat above. Okay, and we have to remember that this correction is very wide relative to the move down which has preceded it, which increases the likelihood of price finding its way up there, giving us what we call an M-style pattern, okay, which will give us that. But that doesn't mean to say that we can't necessarily capitalize on a shorter term move in the meantime, because it doesn't mean to say that price is just going to move to that higher time frame. We could we could be tapping into this area, see a temporary move down, and then we push up to take out that monthly high there. Okay, so as I zoom in, you can see we have a higher time frame liquidity point. What normally happens if we're going to move to the downside? We usually break above them. Okay, catch people the wrong side of the market. What's happened here? We tapped into that area and we're pushing down. Okay, so already price moving to the downside from here is the least probable option, simply because this is a higher time frame liquidity point and it's a sharp move, and normally we break above before moving to the downside. Are there any other clues that we likely need to break above before moving to the downside? Well, yes, you can see, or maybe you can't see, we have moved down. The first clue for me is this candle here, this 4-hour close with a big wick below it. That's buying. That wick below is buying pressure. So what does that mean? It means there's likely orders here. Move when we move down, but it's not like a full-bodied candle, and we have wicks, a big wick below it. That's often indicative of orders being placed up here or still in that area that will likely need to be filled. Okay, because price moved up very suddenly, orders still up there needing to be filled, which ties into the theory of people being needing to be caught the wrong side of the market. You can see that here. This is a big clue for me. Okay, look at this. So we start to get a bit of an impulse down. Look at this. Big wick below the body, big wick below the body, wick below the body, big wick below the body. That, to me, is a very big clue. We can analyze this on the 15-minute. This sharp move there, the fact that we've sold off quite correctively, we've had a sharp pullback. That, to me, tells me that we might get something like this. Okay, but if we get a flag like that, that will be disproportionate to the move down that's preceded it, so high up into a higher time frame run, and more likely that price would give us that to push up, and then this becomes the middle section to break the high and give us that structure, which would catch people the wrong side of the market. It will be the kind of structure that would. So with all of that in mind, I'm already getting clues from the price action. That's why we read the nature of price action. So what I'm going to be looking for from this pair is the same thing. I'm going to be looking for a break above, okay, break above, a break back in, and then the correction, the 5-minute or the 15-minute 3-touch continuation or a 2-touch continuation with this 3-touch structural approach. And just as a kind of shorter term target, what I'll be doing is I will be, so we have the low here, the low of all of this correction. The start of all of this correction was here, okay. What do we have? Although it's a wick, we have a near miss to it, okay? So that gives me a clue that this is an area of value which would likely, even if price did keep going, would likely result in some profit taking in that area. So what I would do, once again, I would measure the range. I'd measure from there to there. And what I would do, just because we have the wick sat just above, I would set the take profit at the wick for something in the region of 7.2%, and I would trail my stop loss accordingly, and that would be what I'd be looking for on CAD Gen. So what I've got here is I've got an alert set at this area here to see if we can push back up and break above all of this and break back in. And if it doesn't trigger, okay, so we have this corrective move down. So I'm expecting anticipating after a corrective move down, an impulsive move back up to break the highs. If we don't get this entry and that alert doesn't trigger, then I'll not be looking to place a trade. So Aussie Swiss, this is a really key lesson. Okay, something I recently discovered about my trading is that, and something I discovered from attending the Falcon, the foundation webinars within Falcon. Although I consider myself quite advanced now, I still attend the foundation webinars because all the things I've got good at in life has been about mastering the basics. So although I attend the more advanced webinars, I also attend the foundation webinars, which I'm probably one of the few advanced people that actually does that, because I'm big on mastering the basics. Okay, and there's some key lessons that I want to talk at when we get down to the lower time frames. So this is partly lower down because what we broke above here is more of an inflection point rather than a standout area of value like that. But the clue to me that this was an area of value is the fact that we had a near miss to it here. We then break above. We kind of only wick just above. We put the sellers get in too early. We break above. Then we see the aggression to the downside. And what I've been seeing this as for a little while is this impulse correction continuation to push lower to potentially, we measure where price actually started to impulse, and we measure the continuation leg, that would actually take us down to that wick there. Okay, previously I was looking for a shorter term move, but just because the risk to reward has changed ever so slightly, I'm looking for a slightly I'm looking at that target there now. Okay, so what's happened, we have a higher time frame liquidity point. We did wick above. Okay, so we could have been seeing moves to the down. We potentially washed out all the liquidity and then we're moving to the downside, but you can see we're pushing back up. Okay, so let's analyze why we're pushing back up. Okay, so the first clue for me that we may push back up is that we have this 4-hour close here with a wick underneath it, and many people may have seen this as a retest of the back end of all of this. Okay, that's a possibility. But okay, we do have to excuse me, we do actually have a correction there. I am mindful of this wick as with regards to what I was saying a minute ago on the other pairs. This wick is a clue that maybe we're not ready to commit just at the moment. However, if we analyze this on the 15-minute chart, we can see that we do have this two-touch structure. Okay, it is quite wide relative to the move down which has preceded it. Okay, which is why I'm being more cautious. And one of the things, this is what I wanted to touch on. Okay, so what I'm going to be looking for from this pair today is the following. Now, what I noticed from my documentation is that a lot of my losses have happened when we've had a two-touch flag like this. So notice I'm always looking for, at the moment, because they're lower risk positions, I'm looking for a two-touch continuation with a three-touch structural approach. What is this? It's a two-touch continuation with no three-touch structural approach. Okay, and one of the things that I learned from my documentation is that a lot of my losses have come on these two touches that don't have a three-touch structural approach. And like, for example, we get an entry there and then you get tagged in, tagged out, and then price moves up to test the high. That's what I've noticed about my documentation. And recently in one of the foundation webinars, Danielle within our community who does the foundation webinars, she said, according to her study of mechanics, Falcon mechanics, which I've studied, I have been studying, but I honestly didn't notice this. She said that any entries that Mark, the founder of Falcon, says in those webinars that any entries, two touches, are higher risk unless you've got a three-touch structural approach. So if you were going to take this, I'm sure some people took this and they would have placed their entry here. Okay, they would have placed their entry there, and then they would have been tagged in, tagged out for a quick loss. I'm sure that's happened this morning. Okay, so if I was going to take this, I would only take it if I was up 2% for the month. These two touches without a three-touch structural approach. And if I was going to take it, I wouldn't actually take this one, because I've noticed as well from my documentation, another good lesson is that when we get a rejection candle like that and it literally only just breaks back below the area of value, I've noticed that a lot of the time this happens. Okay, so if I was going to take this, if I was forced to take this, I would place my entry just below the body of the candle. So I would have it probably about there, and you wouldn't have actually been tagged in and tagged out. That's not something I've discovered from my documentation. That is something Mark, which is the founder of Falcon, does. He said he puts his entry a couple of pips below the entry candle, not actually at the close of the candle, and he says something along the lines of, "Trust me, you'll save yourself a lot of losses." And of course, in this instance, you would. So what do I do if I'm not up by 2% for the month and we have a two-touch flag like this, which doesn't have a three-touch structural approach? What's the solution? Well, the solution for me is a break back down below this area of interest, followed by a two-touch continuation with a three-touch structural approach. So that's what I'm going to be looking for today. Okay, I've got my requirements here. If we get that on any of these time frames, if we get it on the 5-minute, then I would look for an entry on the break. If we get it on the 15-minute chart, I'll look for an entry on the break and within. And if my stop loss looks a bit strange, that's just because the minimum stop loss we go to is 10 pips. You can see there it says 9.9, but it's just a rough illustration. So it's just because of the pip range is a bit different on Aussie Swiss that this looks a little bit strange. So what I'll be looking for is a break back below that area of interest. And the reason being is because this could be a bull flag to push higher, to push back up to here, because this is quite wide relative to the move down which has preceded it, and because we may actually be retesting the back end of that. So if we break back below here and we get this, then that mitigates, or that has invalidated the possibility of this forming and price moving to the upside as much as is possible. So hopefully that makes sense. Feel free to rewatch this if you need to. Sorry, I'm speaking a bit quick, but I'm trying to get this done because I've got 15 minutes or 14 minutes before the webinar. So that's what I'm going to be looking for. And that is, I'm getting quite excited about teaching you guys, what I know, because these little tweaks, this one that I discovered recently, this is the one that has actually taken my trading to the next level. So I know that by teaching you guys these little lessons, I know it's going to take your trading to the next level as well. And I hope I've explained it in such a way that makes sense. As I said, sometimes, you can go off. I can explain these things perhaps a little bit more too quickly because I've been doing this for a while, and you kind of forget that not everybody's at the same level, and sometimes you can go too quickly. But this one here, it looks quite. If we look at this, so this is the last one, Euro Kiwi. We have a near miss to this low, which will likely to be taken out at some point, and we have a non-progressive move up. Okay, so we didn't move up by way of an impulse and tight corrections. We moved up in a very non-progressive way, giving me a clue that this is likely an impulse correction continuation to push lower to take out that low that this low near missed to. Okay, and if we were to measure the impulse and the area of value, which will make sense as I drill down, we measure that and take it to there, that would actually take us down to that area, which would make sense as well, because if we are going to move to the upside from there, we usually break below, okay, and catch people on the wrong side of the market, because this is a higher time frame liquidity point. Okay, what do we have here? This to me is I was looking so we have that kind of the near miss to this sharp move here. We have a sharp move which broke through the brick wall low there, and we have a near miss to it, suggesting that this is an area of value, and this is just a FOMO channel, which perhaps explains why we have that 1, 2, 3 with a bit of a middle section within it, which then breaks out and tries to come back to the area that it near missed to. Okay, what's happening now? Okay, let's have a look. What have we done again? We've near missed to it again, once again implying that this is a area of value. Okay, and how have we sold off? One of the other things I've noticed is, I noticed this quite a long time ago, but a lot of my losses came when we had a first drive, second drive, and what I would do is I would get short here, and all that would happen is I'd be tagged in, tagged out, and then price did something like that. Okay, this is another thing I noticed quite a long time ago about my losses. So we have Falcon Mechanics 101 here. We have the second touch that breaks above the first, doesn't tap into the area of value. And then potentially we have the third touch, which breaks above all of them. And then we get the move to the downside. Okay. And look how we're selling off. The clue that we're likely to push back up is that we have a big bullish candle here. And it's taken us 1, 2, 3, 4 candles to get down to the base of this one candle. Okay. So we've moved down slower than we moved up. Okay. So what I'll be looking for with all of that in mind, I won't be looking for a risk entry from the top, just because of how far potentially we are in terms of this higher time frame run, and because we're in a kind of profit taking area potentially there. What I'll be looking for is I'll be looking for a break above the area of value, a break back in below the area of interest, followed by a 3-touch 15-minute continuation. So not a 5-minute continuation. I'm waiting for more deliberacy because I'm paying attention to where we are on the higher time frames. Okay, I'm not taking 5-minute entries in this area. I'm taking a slightly more weighted time frame. So an impulse down below the area of interest if we tap into the area of value, followed by a 2-touch 15-minute continuation or a 3-touch 15-minute continuation with a 3-touch structural approach. And then I would look to get short on the break or within it, depending on which flag it was. And then I would measure it from range to range, and I would set the take profit there. I would trail my stop loss accordingly, and that is what I'm going to be looking for from Euro Kiwi. As I say, I apologize if this was a bit too quick. Feel free to rewatch any of this if you need to, but hopefully you've enjoyed the thought process. Okay, and we shall see what happens with these pairs. But that is what I'm going to be looking for today, folks. I hope you've enjoyed this and the lessons that I tried to give, and I will see you again in the next video. Thank you very much indeed for watching.